guys, my name is Casey with Austin Credit Care, and today I want to talk to you about what's on your credit report, what lenders are looking for, the different scores you have, how they're calculated, and why this is all so important. And let's just start with that. So why this is important is because in your life you want to you want to buy things. You want to buy a home, you want to buy a car, you want to have credit lines and access to funds. You want to be able to take out a loan to start your new business or for something for your home or your life. So you want to know what lenders are looking at when you ask to borrow money. So let's talk about what's on your credit report and what lenders are looking for. One of the main things lenders are looking for is your payment history. So how many times you've made on-time payments versus your not on-time payments. What's your percentage of on-time payment history? And then as far as accounts that you have paid late on, how late have those accounts gone? How many accounts have you had that have gone 30, 60, 90, 120 days past due? How many were completely, let go and are not derogatory or into collections? What's your payment history like? Another thing that lenders are looking for is your credit utilization. So credit utilization is showing that you know how to use credit responsibly, that you can take out a credit line or a loan and you know how to use a percentage of it and make this payment back. So are you utilizing the credit that's been given to you? And are you utilizing it in making on-time payments? Another thing that is going to sway lenders is your total debt. So what is your total debt between all of the accounts you have, and how much are you paying towards those debts every month? This is really important. This is how debt to income ratio is calculated. So it's okay to have debt. Everybody has debt. It's healthy to take out debts and have loans and stuff in your name, but it's not okay to have too much of that to where every month you're paying so much towards your debt that you don't have enough left over to take on another payment if you need to. So that's what lenders are looking for, your total debt. Another thing is your credit mix. So what types of credit do you have? What banks are they from? Have you had credit with auto loans? Have you had credit, with rent? Have you had credit lines, credit cards? What banks have you had your credit cards with? So this is all really important. And then just your general account age. So if you take an average of each of your accounts, how long have you had them? And kept them healthy before they were closed out. So what is your general account age? So these are the things that lenders are looking for on your credit report. Now you also have different scores. So everybody knows, like, when you pull your credit report, you look at, majority of the time 3 scores. You're looking at TransUnion, Equifax, and Experian. And these bureaus, those 3 bureaus, are how your Fico score and your Vantage score are calculated. And those are the 2 types of scores that lenders are going to be pulling when you apply for something. So let's talk about those and how they are calculated. The first type of score is going to be your Vantage score. Your Vantage score is going to be made of these pretty much the same things that your FICO score is made of, but the percentage of how those things affect you are different. The algorithm is different for how the score is calculated. So the way your Vantage score is calculated is first by 30% of it is your recent credit amount. So recently, how much credit have you had? And then 28% is going to be your payment history. So we explained payment history, how many times on-time payments, late payments, how late have the late payments gone. 23% is going to be credit utilization. So how much of your credit are you using, and are you being responsible with the credit that you have? 9% is account balances. So 9%, all of the accounts you have, generally how big are they all together, how much are your balances. And then another 9% is going to be depth of consumer credit. So how much credit do you have, the different types of credit you have, the longevity of them, the different banks. 1% is going to be the amount of available credit. So how much credit do you have to use? That's just 1% then. The way your FICO score is calculated is a little bit different. So your payment history is going to be more effective. It's going to go from 28% up to 35%. So payments on time are super important. 30% is going to be your outstanding debt. So how much outstanding debt do you have? How much money do you owe? Another 15% is going to be your length of credit history. So in general with your accounts, what's the average length of them? And then for complete history wise, how far does your credit go back? How long have you been established and been able to pay on loans? Generally, the more credit you have established, the more positive credit you have established, the better your score is. The better the length of your credit history is. The fact that you can go back years and say, I've been paying loans and credit lines for years and I've been paying them on time. That's really good. And then 10% is going to be your amount of new credit. So how much new credit do you have that's, you've taken out recently that you have to use? So that's going to be the difference between how your Vantage and FICO score is calculated. So when you apply for a loan, it's important to ask, and not just a loan, but like a credit line, when you apply for anything, ask them what score they are pulling, and then sometimes, they run scores with just certain bureaus. So ask them where they're getting your score from, what score they're trying to pull. So this way, and on a regular basis, you can be on top of the difference. You can, be knowledgeable and keep track of the different scores you have and know when you are going to make it worth it to go and apply for something. If you already know your scores at a certain point, and you can apply for something, you should go apply for it if you're going to get that interest rate you want and not. But if your score is a little lower, you should hold out and just, wait a few more months and put those on-time payments and get your scores up, do some work on your credit, and make it worth it to get that lower interest rate. So that is the reason why, why all this is so important, what lenders are looking at, the differences between your two scores, and why this is so important and what you should be keeping up with. So that's what I have for you guys today. Again, my name is Casey. This is Casey's on Credit with Austin Credit Care. Leave comments below and be on the lookout for more videos.